Hi, good afternoon. I'm James Gomes, Managing Partner at Caliber. It's my pleasure to welcome you all to our 2024 Employee Benefit Plan Conference. We have an exciting program ahead featuring both experts from Caliber and a distinguished speaker, Meredith Golfo, Principal at Slevin and Hart. Throughout the conference, we'll cover essential updates on auditing, accounting, tax, and cybersecurity, as well as important legal and legislative developments impacting employee benefit plans. We appreciate the dedication and effort all our speakers put in preparing their presentations. Before we begin, here's a quick overview of what to expect. Following the presentations, we'll have a live Q&A session, so feel free to submit your questions at any time during the presentations using the Q&A feature. We'll do our best to answer all the questions at the end, time permitting. For those of you that want CPE credits, we're offering 2.5 hours of CPE credits during this conference. There's going to be polling questions that pop up. You have to answer those to qualify for the CPE. At the conclusion of the conference, you're going to receive an email with all the access to all the materials, and you can get the CPE credits as well. So with that, we can get started, and join me in welcoming our first speaker, Glenn Irick, who is an audit partner at Caliber. He brings nearly 35 years of expertise in public accounting, specializing in tax-exempt clients, including labor organizations, multi-employer benefit funds, and other nonprofits. With extensive experience managing hundreds of plan engagements, Glenn has directed numerous management and consulting engagements involving operational reviews, performance audits, and internal control assessments. Glenn is also actively involved in the National Foundation, where he frequently speaks, and he was over there last week. And he also served on the Professionals Committee previously. So with that, join me in welcoming Glenn Irick as he presents. Welcome, Glenn.
Thank you, James. Good morning, good afternoon, everyone. James, you're killing me with that 35 years. That's hard to believe. But I'm glad everyone's here to attend. It's going to be a lighter session on the A&A side than we've had in the past. I have really good news that I'm not going to talk about the lease standard. I know that was a highlight or low light, depending how you looked at it over the last so many years. Everyone is implementing that. Folks that need to, even folks on the employee benefits side that do have leases. So I'm not going to get into that at all. A lot of what I'm going to talk about today, we're going to talk about compliance with the DOL, IRS. I'm going to get into a lot of auditing standards. I know a lot of what we do here at Caliber in auditing our plans does impact the client quite a bit. So the folks that are on the phone related to it, wondering why we're asking for this year, we didn't ask for it in the past. The AICPA, through the Department of Labor, influence also has impacted our standards quite a bit. And we're constantly adjusting to it, and I know you are also. So we'll get into some of the SASs as we go forward into the presentation. Looking at just overall industry stats, from a 30,000-foot level, the total retirement assets based on the EFAST DOL site at the end of 2023 came in about $38.5 trillion. And you can see the makeup of those amounts broken down into many different areas. IRA is the largest by far, 13.6 trillion of that. Then we get into the DC plans, along with the DB plans, state and federal plans, along with the annuity reserves. So in that 3.2 trillion private DB plans, the multi-employer sector, which I know many of you are part of, makes up about 700 billion of that, about 22% of that 3.2 trillion. So it is a big part of the large defined benefit plans, but overall, it's about 2% of the total assets when you exclude those IRAs. So that's, I thought, was pretty interesting. The other good news about the multi-employer plans, I'll just say, the funded status as of the end of 12/31/23 was about 89% across the board. So great news on that end. Clearly, with the market continuing to increase over the years and great management by the fiduciaries, 89% funded status is awesome to see. So we talked about total assets. Let's get into the audits. There's about 88,000 plans that were subject to audit this year, or it would be last year technically. About $10 trillion in assets subject to audit. Again, that's out of about $25 trillion available, as I mentioned on the previous page, when you exclude the IRAs. So there aren't, significant 40% or so subject to audit. There's about 3,400 firms still doing audits, 167 million participants, and about 134 firms that have over 100 in plans that they audit. One of the things that we've talked about in the past, we'll just kind of talk about briefly here. We're in about our third year of implementation of SAS 136. This is a SAS that came about for many years as the Department of Labor, and I'll get into that later, performed their reviews of audits, their feeling that audits needed to improve, and their lack of ability to really do anything about it, other than try to influence and work with the AICPA and others to come out with standards that will improve the quality of audits and performance of audits. And this SAS 136 was it. A big part of these changes, again, were things that were done in the past, maybe weren't codified. Some people did them, some people didn't. So to bring more uniformity to how plans are audited, one big consideration there of relevant provisions. Are you looking at other items? And I'll get into that in a minute. One other change under SAS 136, which is a little bizarre, performance procedures for ERISA section 103A3C. I still fumble over that, which used to be called limited scope audits. So used to have a really easy name. Now it's technically ERISA section 103A3C is the ERISA code that the DOL through the AICPA wanted to change the formal name for that. And I'll talk about that in a bit. Substantially completed 5500s. Another area that the DOL, along with the AICPA, felt there was too much of a disconnect between the audit and the 5500, too many inconsistencies. So let's try to bring them together. You are filing them together, so they should really be consistent. But believe it or not, many weren't. And the AICPA had a major problem with that. So they developed standards around that to bring consistency. And then there's a lot of information in the standard that talks about what the auditor's responsibilities are, the management's responsibilities in our communication and our findings. And I won't get into that. A lot of that was already required before in different formats, but it's something that changed a lot of our audit opinion, which is now probably 2 or 3 pages, almost 4 pages in some cases, compared to 1 or 2 pages. So a lot of information in the audit report, which I know a lot of people don't necessarily read every year, but you really should, because it clearly is a critical part of the overall audit, being the opinion. So relevant plan provisions, again, is something that when we audit our financial statements under GAAP, we're looking for material factors related to numbers in the financial statements. That's the main driver. But the Department of Labor, along with the AICPA, said that's great, but you really do need to look at provisions of the plan document, looking at eligibility, contribution timeliness, other things that impact the plan greatly, may not be overall material as we look at numbers, but are definitely material to the administration of the plan. So all of that, again, it was done in different ways. Different firms do different things, but now everyone has to do it. Everyone understands it's a critical and required part of the audit. So the relevant plan provisions was a big part of it. The ERISA section 103A3C, limited scope audits. One of the things the Department of Labor really has been beating the drum over, really probably the last 20 years, probably longer. I go back 35, I don't remember that far back, but is that so many of these audits that are done are limited scope. For those of you who don't understand what a limited scope is, effectively it's taking and certifying the investment information by a third party, really the bank or financial institution, and really limiting the amount of work that needs to be done in that area and any other related area, investment income and others that relate to it. The Department of Labor felt that just the fact that they're calling it limited scope, people get the feeling they don't have to do much. It's kind of deceiving. That's why they changed the name. But also, they would like people to do more full scope audits. Now, that's going to be more costly. And technically right now, it hovers around 80–85% of all audits are limited scope. So the Department of Labor spent a lot of time with the AICPA, giving them information to say, you need to communicate with your plan sponsors to say exactly what a limited scope is, what people are signing up for, and all of that detail is in the opinion. So it's clear what management's responsibilities are and the auditors related to it. It might be limited in scope in certain ways, but there's a lot of other audit procedures that need to be done. And that's one thing that comes through loud and clear in that document. We don't, as a firm, do many limited scope audits. If we do see them, it may be single employer defined contribution plans. But generally, it's not going to be in a lot of the DB plans that we do. One of the other considerations, as I mentioned, substantially complete 5,500 to ensure there is a 5,500 that's going to be consistent with the financial statements in the evaluation. There was a little trouble out of the gate with the revision of the Schedule H here regarding what box to check. And I think that's pretty much been ironed out for the most part, so I won't go through that. If you do have limited scope or ERISA Section 103A3Cs, you do have to be careful which box you check there, but not an overall really big deal. Looking at other standards that we're required as auditors to follow, they really started reeling them off, starting with the SAS 143, related to accounting estimates and related disclosures. This, again, is one area, especially related to large defined benefit plans that have actuarial calculations, that have alternative investments. They want to make sure that as auditors, we understand the assumptions that are going into those numbers and that we feel comfortable that they're consistent, consistently applied, and there's nothing on that end that we should worry about manipulation or anything else related to that. Now, that was effective for this year. So we did, and we documented much more work related to estimates, especially on the larger DB plans. It is one factor that has come about in many areas related to single employer plans, corporate plans that many people deal with it, related to actuarial assumptions and valuations that go into corporate plans, which go directly, as in the multi-plans, go directly into funding. And is one thing that says, from an alternative investment perspective or an actuarial perspective, if you have these very large estimates or assumptions, you really need to dig in. And they broke it out in 4 categories you can see here. I do have a lot of writing in these charts, and obviously I'm not going to go through all of that. It's more for you as a reference tool. But they talk about the methodology that's done. Is the method of the assumption or estimate appropriate under the circumstances? Are there judgments that are going into this that potentially have negative or positive outcomes that could have bias surrounding it? Is the data that's going into it reliable and accurate? Clearly, from an actuarial perspective, that data is everything, as you know. Plan sponsors that feed the actuaries that information, we do look at both sides of it to make sure that when we test it, that is the data that's going to the actuaries to make their calculations. Clearly, that's critical. And it also talks about management point estimates and disclosures. Is there thought into these estimates? When we deal with outside parties, whether pricing agencies or others, we get the understanding related to that. If it's other valuations that are done by our clients related to assumptions or others where it may not be crystal clear where they got that information, that's where we really got to dig in to make sure there's nothing overall to be concerned about on that end. It continues on, use of specialists and use of pricing information, that if there are specialists used outside of the employee benefit plans, which there always are, right? And you know who that team generally is. You have your management consultant, you have your actuary, you have your valuation specialist potentially. It does talk a lot in this standard about pricing information relating to really not really your standard pricing as much, but your alternatives, whether it's real estate, commodities, what is used, how is it used, and do you understand, meaning plan sponsor, fiduciaries, how you're using your specialists. A lot of people engage a lot of different specialists for a lot of different things, but they don't necessarily peel the onion back. And that's one thing the standard is trying to do, that our clients should be peeling the onion back, and we need to look at that onion peels, quote unquote, to make sure that there's nothing unusual or to be concerned about related to the estimates. SAS 145, understanding the entity and its environment, assessing the risk of material misstatement in line with what has been done since the ACPA came out with risk standards many, many years ago. But it does dig into much more into the information technology controls and general controls, which are clearly very important and something that's been around now for a while. So this is their codification of that. But they do give examples of what the auditor would be required to do related to the ITGCs. They love the acronyms, which is the information technology general controls. They talk about security and access, clearly security. The Department of Labor came up with standards related to cyber now 2 years ago or so. I'll get into that a little bit. I know Brian's going to get into that also. Talking about also system changes, system development, and computer operations as kind of the four pillars of what we should look at. Clearly, we don't do an IT audit, quote unquote, but what we do regarding the risk assessment surrounding that is really critical. So they're putting it here in writing that everyone that's doing an audit is on the same page. It continues on into the 140s through 149. 146, quality management standards for engagement for auditing standards is something that the AICPA spent a lot of time on relating to firm-wide quality standards, quality management standards, more of a risk-based standard. So something that's going to improve firm operations overall. It's going to improve, I think, quality overall based on certain standards that are embedded in that SAS 146 related to partner responsibility, partner expertise, and it will then flow right into what peer review will be reviewing as we and other CPA firms get their peer review every 3 years. Ours is coming up this fall, so it won't be under this standard technically, but that 3 years later will be. So it's really tightening things up on the quality control. And again, making sure every firm that does employee benefit plans or any audits for that matter is on the same page and does the same thing. The other standards, 147, 148 was effective for this year. Not a whole lot of activity related to that. 147 talks about predecessor auditors and additional fraud inquiries that are required. 148 is just a kind of a cleanup SAS. 149 talks about audit of group financial statements. So that won't impact the employee benefit plans at all. That'll impact other organizations that potentially have group audits. We have a poll, our first poll of the day. Folks that are getting CPE, if they could please answer this. Were you aware of any terminology change from limited scope to section 103A3C? I guess aware before I started talking about it. Give everyone a minute to do that, or 30 seconds. Okay, the summary page here, again, I won't go through it in detail. You can read it, but it does talk about some of the highlights of SAS 146 to 149. As I mentioned, the audit engagement partner becomes more critical and more critical in responsibility, especially to the audits going forward. Predecessor auditors, bringing them in the fold for fraud inquiries and understanding of fraud. Was a little surprising that wasn't in there before because that's something we inquire with our clients, our due diligence to bring on a new client. It's always there in discussion, but it was never actually formalized. So now it is. Looking at other standards that we are getting ourselves into a little bit, the AICPA ANA audit guide is something for the employee benefit audit guide is something we use all the time related to our employee benefit audits. Used to carry it around. No one carries it around. Everyone has it electronically. Hopefully they're reading it as much as they used to. But that's going to be updated as it is every year. And it is updated now. Bringing into play some recommendations from FINREC related to revenue sharing agreements. We don't quite see that as much as we used to. Changes in participant count methodology for defined contribution plans. That's the thing I wanted to touch on related to who needs an audit, right? Something that people get a little mixed up on at different times. If you've been rolling through audits for many years and you're well over 100 participants, you really don't have to worry about it because chances are you're going to have an audit. The folks that are hovering around 100 or anywhere near there, the main change with this participant count methodology is previously, or up until last year, the requirement for an employee benefit audit effectively was, if you have 100, and there is a provision for 120, but I'm not going to get into that. If you have 100 participants that are eligible for your plan, you're going to have an audit. So eligibility clearly had a difference between who was in the plan actually having an active account and who met the eligibility requirements. There's always a difference there. Eligibility participants are always more, sometimes much more, depending on the client. So what the AICPA decided to do, which goes against a little bit what the DOL wanted, was effectively, okay, if you don't have as a participant an account in the plan as of the beginning of the year, that's not going to go towards determining if you need an audit. It's strictly based on folks and participants that have accounts. So it could potentially flip you into a non-audit situation if you are anywhere near 100. So just keep that in mind. I did have a few clients, 2, I think, and I didn't hear about many others that actually didn't require audits this year, that previously they had eligible participants that exceeded 100, and then they dipped under it once you look at the account balance activity. And that's all accounts for active and terminated employees. So just keep that in mind. So that changed. Secure Act 2.0 and Secure Act provisions, plan amendments for that were put in the audit guide. Updated the adjustments, the annual penalties. They go up every year for the most part. And then there's 403B activity and illustrative notes in the financials that were not in the first version of the employee benefit guide were added. The employee benefit guide now, for folks that work on multi-employer plans, there is its own chapter now. And that was pretty exciting when it happened. That happened, Jackie Dunn, head quality control person here at Caliber, did work with that group to get that and the provisions of the multi-employer chapter codified into the audit guide. So we love to see that. Other activity related to compliance is something that came out related to FINREC, related to accrual of amounts that are being withheld for participant contributions, along with matching contributions. We don't see this that often overall. People have done it, I guess, a few different ways, and it was always somewhat acceptable. But FINREC effectively said for defined contribution plans, generally, depending on your pay date, depending on when you withhold the amounts for contributions, both the employee and the match, you have a choice. They're giving you a choice here. Normally, we don't get choices. We have a choice here. You can either accrue it and say that, oh, this contribution was for the last 2 weeks of the year, and for that, we're going to accrue the amount of match that is required to be paid as of the end of the year in a pure accrual basis situation. Or you can wait till the amount is withheld, and you can do it on a more cash basis. And that's probably what we see more than a full-blown accrual basis for amounts withheld. So you do have a choice. I think the most important thing of this standard that did come out from FINREC is just be consistent. Don't go back and forth based on circumstances. If you're planning to accrue it, do it every year. If you're not planning to accrue, just be consistent with what you're doing. And that's one of the main premises that they ask that people adhere to. All right, DOL. Back to the DOL. The DOL, again, has been beating the drum many years over quality of audits and improvements that need to be made. So they came up this year in 2023, last year, for their 4th iteration assessment of the quality of audit work by independent qualified public accountants. The good news is 70% of the audits were fully compliant with minor deficiencies under professional standards. And then the bad news is the other 30% that really weren't, some major deficiencies under gaps. So there's been a lot of improvement in this area over the last really 10 years, especially for many different reasons, some that I'll get into. But it's something, again, that we're always zeroing in on. Other firms are always zeroing in on. No one's perfect. There's always going to be findings. But the fact that it's improving is definitely a positive. I don't know when the Department of Labor necessarily is going to come out with the next assessment, but they have been making their way to CPA firms and other. They were at our firm last year doing quality control and actually testing of certain clients. So they're out there. They're definitely out there from a perspective of compliance. But some of their findings that they did come up with And again, I won't go through all of it, relates to a clear link between the employee benefit plan audits and the quality of audit work overall. And I know part of that relates to the dabblers, as they referred to in the past, folks that don't do many employee benefit plans. There's individuals over the last really 10 years that have decided to retire, get out of the profession, and the number of dabblers is down quite a bit, and I'll get into that in a minute. The DOL felt peer review practice and practice monitoring efforts didn't really help identify deficient plan audits. Now, for peer review, as someone every 3 years will come into the CPA firm is a requirement for anyone that does employee benefit plans. There's also a requirement to have a specialist, an employee benefit specialist that actually will look at the firm's work specifically related to employee benefit plans. The DOL didn't think, at least from their review of it, there were enough findings there. They felt there should be more findings in peer review that they didn't see. So there they asked the AICPA to tighten it up. Maybe there's something that they can do to improve that. Who knows? Number 3 there, Employee Audit Quality Center is something that if you belong to that, you did have a lower deficiency rate, a lot of resources in there, so that makes total sense. And the number of dabblers effectively. If you even look at number 4 here, we had 7,300 firms in 2011 that did employee benefit audits. We're down to 4,300 firms. And again, part of that is people getting out of the profession. Part of that is consolidation, a lot of different reasons, but we sit about 4,300 firms. Still a lot of firms, but not nearly as many as we had just 10 years ago. And then, as I mentioned before, the firms that do 1 or 2 audits, almost 3,600 back in 2011, down to 1,700, represents 40% of the total firms. So the smaller firms that, again, only did 1 or 2 of these, it didn't really make sense for them to do it. It's hard to be an expert doing 1 or 2 a year, and there were major problems with them. So good news on that end, that the number of firms that are doing them is shrinking a bit. Certain recommendations the DOL had, I won't go through all of them. A lot of them I already mentioned related to our peer review program for the AIC to look at that. The other theme that goes through these recommendations also is the state societies of CPA firms need to be more active in training, be more active in holding CPAs accountable. And that was one thing the AICPA over many years have been dealing with state agencies that are all different. A lot of different resources in different agencies, a lot of different objectives in different agencies. So I can see where there's inconsistency there. But that's one thing the Department of Labor really wants to see it and give it more teeth, because that, in our perspective, the most important agencies we deal with, the licensing boards, because without a license, clearly, you're not able to practice. So the AICPA trying to develop more tools for that, but it's been somewhat of a slow roll. Talk about 5,500 revisions that were impacted this year, already filed. So you've already seen them, hopefully. You did a 5,500. Schedule H changed this year. You're probably aware, you saw that. A few new categories. This is part of the modernization data mining the Department of Labor wants to do related to different fees, specific fees. There's about 6 or 7 different categories here that weren't here last year specifically. They were grouped in different categories. Salaries and allowances, audit fees on its own individual line, bank and trust company custodial fees, actuarial fees, legal fees, other trustee fees and expenses have its own line. So this is going to be easily accessible to not just the Department of Labor or the IRS, but to any members or any other folks that want to see it. So that was a pretty, not significant change, but a change that was made. Changes related to the participant count methodology. I already went through that with you, so I won't repeat myself there. Schedule R, which is a retirement plan schedule, does have additional questions related to compliance, discrimination testing, asking you straight up about that, talking about adopter of pre-approved plans, enter the date of your opinion that you received, and your opinion letter serial number. So they're trying to, again, cross-check some of their databases. So 3 new questions related to your Schedule Rs. Secure 2.0, I won't get into that because there's going to be discussion on that later. IRS did have some improvements to their self-correction program, expanding the years for the correction period for significant failures by 1 to 3 years. So the IRS has taken additional steps to help with compliance, especially the self-correction programs. IRS has definitely taken a step also in the forfeitures area. This in different ways has been around for a while, but now they're effectively saying, if you have forfeitures, which many plans do on the defined contribution side, you need to treat them with care. And we have some regulations surrounding it. Forfeitures will be used no later than 12 months after the close of the plan year. And forfeitures must be used for the following purposes. Pay administrative expenses, reduce employer contributions, which we see a lot, and increase benefits to participants. So a little more teeth around regulations surrounding forfeitures. I guess some people over the years have been accumulating them, and that's no longer going to be acceptable. So one thing that I know the Department of Labor really and the IRS has been keyed in on. So if you have forfeitures, keep your eyes open and make sure you're aware of this regulation that came out. The last thing I just wanted to say real quick, and I know Brian's going to get into that a little bit, from the DOL audit perspective. Oh, we have another polling question. Have your funds, clients been subjected to a DOL audit? Surprisingly enough, I was just going to bring that up. The only thing I wanted to say in conclusion here, I'd be remiss without bringing up the cybersecurity information that I know the DOL came out with now 2 years ago, maybe coming up on 3 years. Ones that a lot of our clients and a lot of others had a lot of momentum going into it. There's clear indication based on DOL audits that cyber review will be part of it. Quite a bit of information will be requested. The department does say informally that they're using it as information gathering at this point, not necessarily enforcement. Who knows what that's going to look like anytime going forward, depending on who you're dealing with across the country. But the cybersecurity issues and things that are coming about and the information from the DOL is something that we still need to focus in on and make sure we don't lose sight of. And I thank you very much for attending my session. I will turn it back over to James.
Thank you, Glenn, for that comprehensive update. Our next presenter is Mary Margaret Prange. She's also an audit partner at Caliber. Today, she'll be guiding us through the collections and payroll auditing procedures. Mary Margaret has extensive experience also with EBP audits. She's not only an experienced auditor, but she also is a respected educator. Mary Margaret frequently speaks at seminars, including this past week at the International Foundation meeting in San Diego. And she's also developed several courses on auditing, accounting, and other various programs. With that, welcome, Mary Margaret.
Thank you so much, James. Great to be here with everybody. I guess because I'm a woman, they didn't say that I'd been working for 23 years, so not quite as long as Glenn, but I have been around for quite some time, my entire career with Caliber, which is very exciting. So I'm going to be talking to you about a guide to collections and payroll auditing for those of you in the multi-employer space. So we are going to be looking at developing and implementing a strong delinquency policy, how the plans can work with their employers to kind of improve reporting as they're going along so that they're not always relying on payroll audits to find the errors. Increasing collections through payroll audits, just to help make sure that the plan is getting all of its money. And then communication between collection attorneys and the fund office. All right, so a strong delinquency policy, really our rules of engagement here. So we want to make sure that it includes several different things. We need to make sure that it defines when the employer has to actually become delinquent. You know, is that going to be as of the postmark date of when the mail was sent, or is it going to be as the arrival date when it was stamped, arrived, and checked into the fund, if the money is actually coming through the mail still. So I know plans have implemented electronic payments, but some are still accepting some through the mail. You may be getting remittance forms electronically, or you may be getting those through the mail. So just make sure that this is clearly defined in the delinquency policy so that it can be applied consistently across the fund. talking about the timing of the notice letters that are going to go out from the fund. You know, is it going to be 7 days, 10 days, whatever it's going to be? You want to make sure that that's defined in the policy and that that's being applied consistently. You may have to involve counsel. So if you have issues where you're still not receiving the money as of its original due date or has been sent from the fund, you may have to get counsel involved. So you want to make sure you're setting up regular communication with your collection counsel, and getting them involved to make sure that money's coming into the plan as it's supposed to be. When payments are late, the plan administrator or someone at the plan does need to calculate interest and liquidated damages. On the next slide, when we flip over to that, you'll see I've pulled together some of the interest rates going back from Q1 of 2019 through Q3 of 2024. They are broken out between over and under payments, so you can take a look at those. But setting a bright line for when collection costs will be passed on from the attorney. You want to make sure that that's clearly indicated in the delinquency policy as well. What happens when contributions are over-reported? This should also be addressed in the delinquency policy, so that there's, you know, a clear definition of that. You don't want there to really be anything that is not clear to the employer, should they have excess contributions or erroneous contributions coming into the plan. You might have plans that have collectively bargained employees, and you also might have in that same plan employees that are contributing under, or employers that are contributing for their employees under participation agreements. So the delinquency policy also needs to apply to them. So anything that's included in those collective bargaining agreements that would also need to be included in the participation agreements. You need to make sure that gets included before the employer signs those participation agreements. And I will flip us over to the next slide, and this will just kind of give you a breakout. And I know the numbers are kind of small, but you can see how the interest rates for the overpayments and the underpayments, you know, have started back down in early 2019, around 6%. Then they flowed down to about 3% as we saw interest rates were down, but they are now up to about 8%. All right, so working with employers to improve reporting. So I think this is one of the things that I think can be most valuable to the fund, in addition to obviously having a strong payroll audit program that the fund has in place, but making sure that there are clear directions on the remittance reports, whether they're online or they're in paper format, how to complete the report. Reaching out to the employer when something doesn't look quite right on the remittance report. This is going to be from training your folks that are processing the remittance reports, you know, to really be keen to, you know, seeing discrepancies between months, looking for things, you know, and that's going to come with experience and their time on the job. But I think that can be a real value to the fund if they're able to really, you know, take ownership of that and notice when things don't look quite right, and then reach back out to the employer. Training the employer's new staff. There's been a lot of turnover that we've seen over the last 5 years. Folks are retiring in droves. Folks are leaving, you know, for different places, looking for different opportunities. So we have a lot of new folks that are at different employers, and they're getting trained by the folks that are leaving. They might not have gotten all the information. They might not have understood the information that was relayed to them. So if there's a way that the fund, if they see errors consistently or starting to crop up, you know, reach back out to the employer, say, can we help you with this? Is there some explanation you need? Can we provide more clarity on how to submit the remittance reports? And then I think one of the key takeaways that I'll talk about at the end of the presentation is just lunch and learns with a group of employers. Common remittance errors that are seen when the reports are coming in, and just communicating that to the group of employers. Why the payroll audits are conducted, the common payroll audit findings, what to avoid, how to complete the remittance reports correctly. This can be a huge resource to the fund. And ultimately end up cutting down some of the payroll audit costs. If we're not noticing as many errors, it doesn't take the payroll auditors as long to get through the work. So this can be a real money saver and headache saver for the fund. Increasing collections through the payroll audit. So this is going to be kind of the last resort of the fund, to help make sure that the contributions are coming in. This is going to be your detection, your discovery of errors. So communication and consistency. The fund should have very concrete collections policy that includes the fact that payroll audits will be completed, what the process will be, and what the procedures are. The payroll audit cycle should include all employers that are audited over a 3 to 5 year period. For some of the really large national pension funds that are out there, that cycle might be a little bit longer. Things that'll come into play with determining which employers should be audited and making sure that you have audited enough for each of the financial statement years is looking at, maybe kind of breaking down the population of the employers by size. You might have a group of large employers, like medium size and smaller size, and then taking a look into not only how many employers have been audited, but how much of the contributions have you actually audited with the employers that have been audited. I think new employers should have a courtesy review. It doesn't have to be a full-blown audit, but within their first year, just to make sure they're set up for success, that they know how to complete the remittance reports, that the contributions are coming in timely and correctly. Employers that are exiting the plan for some reason. So you want to make sure that you confirm that no additional contributions are due before you get too far down the line. Any delinquent employers, they might be audited more often. They might be part of a target audit. They might not be part of your regular payroll audit process, but making sure that you are taking that into account when the employers are selected for audit. And then periodic delinquency meetings. We call this group the A team. So it's going to be your fund administrator, the attorney, and the payroll auditor. Hopefully they can meet ahead of time and then be able to present that information to the trustees at your trustee meetings. But just making sure that all of those parties have really communicated well with each other and are relying on each other to help make sure that the payroll audit process goes through as it was intended to go through, that you're staying on top of employers that might be non-responsive. You're staying on top of additional questions that maybe the payroll auditor has sent back out to the employer, and that you're making sure that those reports are coming in, they've been approved, that the employer agrees with the findings, the fund agrees with the findings, and that any monies that are owed to the fund or any monies that are owed back to the employer, that's being processed in a timely way. So how can the fund office help with the payroll audit process? Well, they're a big part of this program and making sure that it goes smoothly. So they are going to be providing the auditor with current collective bargaining agreements, participation agreements, any memorandums of understanding, any reciprocity agreements. And that should just be, regular process. Each year as you're kind of going through the payroll audit process, just make sure that the payroll auditor has been provided with those current documents, because they do change. And if they need any additional documentation, that question is posed as well. You need to provide the auditor with a participation history report. So this is going to be your contribution reports or your remittance reports. This is going to be provided for the ones that have been selected for audit. There is probably going to be some questions. So there are going to be questions that come in from the payroll auditors regarding some of the remittance reports once they kind of dive in and start getting information from the employer. So you just want to make sure there's regular communication to make sure that those questions are answered in a timely way. I want to send correspondence to the employer. So once the employers have been selected for audit, the fund is then going to have to send a letter to those employers indicating that they have been selected for audit and who is going to be contacting them. sometimes the attorney will review, the outside counsel will review those letters. But you just want to make sure that those go out in sufficient time for then the payroll auditor to then reach out and indicate what documents they are requesting, and give an appropriate time for the employer to be able to provide that documentation. You're going to want to indicate whether you want this to be done as a desk audit or whether the payroll auditor is going to be coming on site. And sometimes that can be a decision that the employer is involved in making. But other times it might be that the payroll auditors indicated the audits go more smoothly if we are on site. And so that's going to be the requirement. Not that we ever see difficult employers in the payroll audit space, but it does sometimes happen, and for many different reasons. Turnover at the employer, different things going on. So the auditors are going to reach back out to the fund and indicate which employers they have been unable to successfully schedule a payroll audit for. And so at that point, the fund is going to want to get involved and reach out to the employer to say, hey, we let you know that you were selected for audit. You know, the payroll auditor has reached out to you. They haven't heard any response, or they've gotten very limited information back from you. They haven't been able to schedule the audit. Even after that inquiry has been made and the fund has gone out to the employer, there still may not be a response. So then you might need to have the counsel get involved and say, you know, we're doing this audit. You've got to participate in this process. So the counsel might get involved on that. And then helping to follow up on collections. So if there were any discrepancies noted, the fund is obviously going to be responsible for following up with the employer on those collections. So the payroll auditor, how are they involved in the collections through the payroll audit? So you may have one payroll auditor, you may have several, depending upon how the fund is set up. There could be if it's a local plan, there may be kind of a working arrangement with the national plan, where if participants are participating in both, there could be audits that are done to the national plan that would also apply to the local plan. So the payroll auditor needs to demonstrate a very solid understanding of the collective bargaining agreement, the participation agreements, if there are any, the plan document, the collections policy. They also need to understand the industry in which the plan operates, because that's going to help them to find the greatest risks that exist for those audits. And it will help them design kind of the most effective procedures that they can perform to make sure that they really are finding any errors that could possibly exist. They're going to want to tailor their procedures to find those errors. So the employer could be using non-union employees or subs, which they really are not supposed to be doing. And so they would need to tailor their procedures to be able to look for those types of payments that are going out, so that they can, you know, test to make sure, well, wait, you know, this person should be a part of the union. There should be contributions coming in from them. The employer could be paying cash for covered work. So they might want to request a cash disbursement journal so that they can look to see what cash payments are going out. Hopefully there aren't any, but there are sometimes, and looking to see what those payments were for, and should those have had contributions to the plan attached to them. So this is why the payroll auditor requests the full payroll report. And also that cash disbursement journals and the 1099s. And that's often a question that we get from the employers when they receive the notification from the plan saying they've been selected for audit. We send them a listing of things that we would like for the payroll audit to commence. And oftentimes we get a question from them, why do you need the full payroll audit? Why can't we just provide you the payroll that is related to the union employees? Well, because that's not really a complete population. We need to be able to see all of the payrolls so that we can make sure that there aren't people that have not been included in the union payroll that should have been included in the union payroll. We've also seen a very creative use of the language In the CBA, it might reference temporary employees. And so the employer might be calling them seasonal employees. Technically, that's really kind of the same thing. And so they would need to have contributions that are made for them to the plan. Potentially. If there are rules for the number of days until eligibility starts, the contributions are required from the date of hire. That would need to be something that the payroll auditor tailors their test to be able to determine, okay, this is a new hire. They did finally reach eligibility, but contributions have to go back from the start of when they began commenced employment with the employer. Holiday and vacation. The CBA will dictate whether this is supposed to be part of the base for the contributions. And if it is, then the payroll auditor's procedures would need to test for that. So those are kind of some of the more common issues that we find when we're doing the payroll audits. So just a question here, a poll. Delinquency policies. Does your fund have a delinquency policy? Yes, no, or if you're not working for a fund, it would not be applicable to you. So hopefully, if you're working for a fund and participate in the process of the financial statement audit, this is not a new concept, that there is a newer chapter to the AICPA audit guide on payroll audits that is applicable to multi-employer plans. So I don't say new anymore, because we did wait for a long time for it to officially come out, but it has been out for a little bit now. So I just refer to it as a newer chapter. But it requires the plan's financial statement auditors to have clear audit evidence of payroll audits that cover some portion of the financial statement audit year for the plan. So this was never spelled out explicitly because there was no multi-employer chapter of the AICPA audit guide for employer benefit plans, but now it's explicitly says that. It doesn't give a number or an amount, so it really does come up to the auditor's judgment. And that incorporates our risk assessment, what other procedures that we're doing to get comfortable with collections and delinquencies and things like that. But it does require some, so there has to be some. It also requires the plan financial statement auditor to document an understanding of the payroll audit process and determine whether it's adequate for determining whether contributions are complete and have come into the plan the way that they're supposed to. That includes looking at the competency of the payroll auditors, the different types of training, the quality control that they have in place before reports are released, the audit program that they have in place, has an appropriate risk assessment been done to make sure that the payroll audits will actually look for errors that could occur. So that is something that is included in that newer chapter. The payroll auditor is required to document their audit methodology and to have that included in an audit program. List of items are going to be requested from the employer. They need to demonstrate that all of the items that they requested were received, or potentially there may be a scope limitation on the audit. Need to document the employer's payroll system, how it operates. I have seen this done through, a meeting, walkthrough that's done where, we look at, how the employer is processing the payroll, each of the however often they do that, or it can be done through a questionnaire or a combination of both. I think the questionnaire is really nice because the employer can kind of use their own words to kind of describe what's going on, and then a meeting can kind of occur to kind of walk through what they indicated happened. So it's just a nice way to have that documentation. The payroll auditor needs to understand how the payroll is presented on the payroll report. So are we looking at paycheck date? Are we looking at work period date? What is it? Do we have calendar year end? Payroll reporting, is that going to be adequate for the procedures that we're performing, or do we need more detailed information? So that's just something that will have to be a conversation that the payroll auditor has with the employer. They also need to understand how overtime is presented, and what's included in any other columns that might be presented on the payroll audit, on the payroll reporting, so that they understand what to include in the base, so that they're calculating the correct contributions. And as I mentioned before, I need to make sure that there's that full population of the payroll, so that they have all of the information that they need, to make sure that the auditor can determine who's covered and who's not covered. The audit program must also be designed to identify errors and deficiencies. So just making sure that that is, something that's looked at, not just kind of set and forget, but, there are things that change in the industry, that can impact how the payroll audit should be performed for that particular plan. Just a couple other things here. So increasing collections through the payroll audits and how the payroll auditor can be used in this space. So an exit interview at the end of fieldwork, I think, can be really helpful to make sure that any items that needed to be clarified based on the testing that was done on site can be asked of the employer, and they can provide any additional information. If they're not able to provide that additional information at the time of the exit interview, you can discuss the timing of when you would like them to be able to respond, and kind of make sure that you're both on the same page. Any preliminary findings can be reported for the employer to dispute if they have any dispute for them before the fund administrator or the fund is kind of involved in what the findings are. But there should be a detailed report to separate kind of reasons for exceptions for easier dispute discussion. Communication between the fund administrator and the auditor on any open items that the auditor can't resolve. So this might entail getting counsel involved in this space, but hopefully not. But any questions on the CBA interpretation, obviously the auditor cannot be making interpretation decisions that would need to go to the fund or potentially have counsel involved. Employee classifications, just making sure that the auditor understands which class of employees that the ones that have been selected for testing are in, so that they can calculate the correct amounts of the contributions. And then any over-reported contributions, that usually will entail getting the counsel involved to make sure that those are processed according to ERISA. But again, communication with that A team to make sure that everybody is really involved in the process and helping the payroll audit program move as it was designed to. So prior to the beginning of the payroll audit program, I think it's a good idea to have legal review the pre-audit letters, just to make sure, even if it's just the prototype, to make sure there isn't anything that needs to be changed. Agree on the audit period. Is it going to be a year? Is it going to be 3 years? And then to review the selected employers. Contact collections attorney promptly if there are any employers that are not responding to the audit request, so that the collections attorney can get involved and make sure that those audits are still getting done timely, even though they might have some delay because of non-response. And then also for any employer's refusal that the fund office that cannot resolve, obviously the council will need to get involved in that. And then post-audit, collections assistance after 1 or 2 collections attempts, this would need to happen. And then reviewing the amount of delinquency to determine next steps, what needs to happen at that point. And then assembling documents for filing suit. Although hopefully this is not a route that you're going to have to go through, because this is very time consuming and also can be very costly for the fund. So key takeaways from this session that we just went through, making sure that you have a consistent policy for your delinquencies and your collections. It needs to be established. You need to review it, and then you need to consistently enforce it. If you have not taken a look at your collections or your delinquency policies in, I would say, over 3 years, it might be time to kind of take those out, dust them off, and take a look and make sure there isn't anything that needs to be updated or clarified. But this could be a good time to do that before we kind of roll into 2025. Develop a nice timeline for notices and responses, collections, and follow-up. It would be good to kind of identify a key group of employees at the fund that's kind of responsible for making sure that, you know, each month this contributions are supposed to be coming in. If any employers haven't remitted, then they're all sent notices at the same time. And then after those notices go out, if they don't receive the contributions at that point, that council is involved. So that just make sure that the wheels on this bus keep spinning as they're supposed to, because that's really going to help the contributions come in as they should. Regular delinquency and status meetings with the A team. This is going to be super important to make sure that the process is running as it should. Educating employers on common issues and discrepancies. I think if the major takeaway that you have from this session today could be to have those lunch and learns on a periodic basis for employers, that would be wonderful. And then just to make sure that communication is happening. Communication down to the employers, and then communication to the trustees, communication to the A team, just to make sure that the payroll audit process is happening as it should, that collections are coming in, that they're accurate, that they're adequate, and that should help the fund make sure that those contributions are complete in the financial statements. And I think that's it.
Thank you, Mary Margaret. A lot of great information. Let's take a quick 5-minute break and we'll come back at 1:10 Eastern. All right, welcome back, everyone. Now it's my pleasure to introduce our guest speaker, Meredith Golfo, principal at Slevin & Hart. She's been with the firm over 20 years, specializing in multi-employer benefit plans under ERISA. Her practice covers a wide range of services, including representing clients in front of the DOL and IRS investigations, drafting plan documents, and advising trustees on fiduciary responsibilities under Title I of ERISA. Meredith also has broad expertise in negotiating investment contracts, such as hedge funds, real estate investment trusts, and private equity arrangements. She's counseled DB plans on the relief provisions under the Pension Protection Act of 2006 and the Multi-Employer Pension Relief Act of 2014. Please join me in welcoming Meredith as she presents our legal and legislative updates on benefit funds. Meredith.
Good afternoon, and thank you, James. So we're going to spend about the next 35 to 40 minutes discussing what's been going on in the legislative and regulatory world over the last year. That's not a lot of time to hit on everything that's been happening. So we're going to take a pretty broad overview and hit some of the highlights. So generally what we're going to discuss today are regulations issued by the Department of Labor regarding who's an investment fiduciary, final regulations issued under Secure 2.0. We're going to talk about some guidance that came out from Treasury on some optional distributions from defined contribution plans. And then lastly, we're going to talk about rules that came out to implement the permissive matching contributions on qualified student loan repayments. So we're going to start with talking a little bit about investment fiduciaries. And interestingly, investment advice is the only type of advice that is discussed in ERISA. They don't talk about legal advice or accounting advice, actuarial advice. They talk about investment advice. And specifically, Section 321 of ERISA provides that a person is a fiduciary with respect to a benefit plan if they render investment advice for a fee with respect to money or other property of the plan. So that's the statutory definition that we start with. And the reason why this is important is because if somebody is classified as a fiduciary under ERISA, then they're subject to the standards of care that apply to a fiduciary, which are the highest standards of care recognized under the law. In addition, fiduciaries have an obligation to avoid prohibited transactions where they act in their own best interest rather than in the best interest of the plan and its participants. So when somebody is getting advice from somebody that's an investment professional, it's really important for them to know whether that person is giving them advice in the capacity as a fiduciary or not, because that gives a lot of comfort in the ability to rely on that advice. So when ERISA was enacted in 1976, that was a period in time where the most common type of pension plans were defined benefit plans. Defined contribution plans were just starting to come into an existence, and 401k plans didn't even exist yet at this time. In the defined benefit plan, as I'm sure many of you know, the plan's assets are managed by investment professionals that have a lot of experience in managing assets. Contributions are funded by employers, and participants are given a promised benefit. So the risk of underperformance of the investments really rests with the employers to make up any deficits, as opposed to the participants who get their promised benefit unless the plan were to go insolvent. So when ERISA was enacted and the DOL first issued regulations regarding who's an advisory fiduciary, those regulations that came out in 1975 were really more geared towards this defined benefit plan type of arrangement. But over the last 50 years, there's really been a shift away from the defined benefit plan structure towards defined contribution plans. And in a defined contribution plan, there's also been a shift from where the trustees make the investment decisions to where the participants make their investment decisions and decide how to allocate their account balance among different investment options offered by the plan. So what's been happening is the investment decisions are being made by the same people now, the participants, who are going to bear the risk of the underperformance, because in a defined contribution plan, the risk of underperformance is on the participants in that they would suffer investment losses to their account balance. So when the 1975 rule came out, defining who's an investment fiduciary, it was a 5-factor test. And I had the factors listed out for you on these slides, but what's the general idea is that the rules where it's very specific that to be considered an advisory fiduciary and subject to these standards of care we've been talking about, the advice has to be given on a regular basis under a mutual agreement with the plan that the advice is going to be the primary basis for decisions made with respect to the investments of plan assets, and that it's individualized for the plan. So this is a very specific definition that works well in a trustee-directed setting when you have, for example, an investment consultant that's giving advice on how to invest the money among different investment managers. It doesn't work as well when you have participants that have to make the decisions regarding the investments of their own accounts. So taking that into consideration, the Department of Labor has attempted at least on 4 occasions to rewrite the 1975 rule and brought in who it would be considered an investment fiduciary. And each time they've issued a rule, either as a result of political pressure or court rulings, the implementation of those have been blocked. Most recently, a final rule was released in April of 2024. The first lawsuit was filed in the federal district courts in Texas in May of 2024. And in July, 2 district courts in Texas issued a ruling to delay the effective date indefinitely of the new rule that we're going to talk about in a second that came out in 2024. So right now that rule is not in effect. We are still subject to the 1975 rule. I will note that the Department of Labor has filed an appeal of these rulings up to the 5th Circuit, but there is a lot of speculation that when the new administration comes in, that appeal will be withdrawn and the 1975 rule will remain in effect for at least the next 4 years. So had the final rule from April of 2024 gone into effect, what it would have done is broaden the definition of who's an investment advisory fiduciary to include anybody that gives advice or recommendations for a fee, and they make professional investment recommendations on a regular basis as part of their business. So it's less targeted to the person they're giving the advice to and more targeted to that they're giving advice as part of their business. And given their status, there's a reasonable expectation that the information they're providing is targeted to the individual and reflects the advisor's best judgment of what they think is best for the participant, and it's reasonable to believe that that advice would be relied upon. So it's much more of an objective standard than the 1975 rule. And just to parse this through in a little bit more detail, these are some of the major differences and some of the issues that the department was trying to help with when issuing the new 2024 rule. One is they wanted to get rid of the requirement of having an explicit agreement, understanding that oftentimes participants may sign something where there's fine print on the bottom that says, don't rely on this information, it's just for informational purposes only, and that would negate the requirement of having a specific agreement that the person's advice is going to be relied upon. They also wanted to eliminate this ongoing relationship requirement so that if you had a situation, for example, in which you're a participant and you get a letter from your employer saying, now that you're no longer working for the company, you can leave your money with the plan, you can roll it into another plan, and you don't know what your best option is. And it says, if you need information about these options, please call us and we'll give you information. And then you call a company thinking that they're going to give you advice that's in your best interest. And because they're giving you one-time advice on how to handle that account balance, they're not an advisory fiduciary under the 1975 rule because there's not that ongoing relationship requirement. And then the third thing that the government was trying to get rid of is the requirement from the 1975 rule that the advice become the primary basis for actions taken by a fiduciary with respect to investments. And the reason for that is, if you're a defined benefit plan trustee, for example, and you're thinking of engaging in a complicated real estate transaction, and as a prudent fiduciary, you want to hire more than one company to give you advice, each one could argue that their advice is not the primary basis for the decision, negating their status as a fiduciary. And that's not something that we would want seen out there. So those are some of the issues that the DOL was trying to guard against. Unfortunately, for the time being, we're going to be with the old 1975 rules, but just something to keep in mind if you're a trustee looking to change from a defined benefit plan to a defined contribution plan, the level of protection your participants will have for making investment decisions. All right, so we have a poll question, but me being a lawyer, it's not really a poll question. It's more of a, are you paying attention question? And we haven't gotten to this yet in our slides. So I'm going to give you the answer. Hopefully you're paying attention, which is B. And I promise we'll talk about this in a little bit. So it's the second bullet point. Okay. So talking now a little bit about Secure and Secure 2.0. Final rules were issued earlier this year in July 19th of 2024. And the focus of these rules was on the required minimum distribution provisions. And that's what I want to spend the bulk of our time talking about, because there are changes that will be important for your plan coming in 2025. So the final rules are effective on January 1st. And they say that plans are protected as long as they had a reasonable good faith reliance on the rules that were in effect prior to Secure 2.0, and then taking into account the statutory provisions without any implementing regulations. There is a delayed effective date for plan amendments. So most plans won't need to be amended to reflect the provisions of Secure 2.0 until December 31st, 2026. But there's even further delayed effective dates for collectively bargained plans and governmental plans. And just to keep in mind, the IRS issued some proposed rules on the same date, implementing some other provisions that were reserved in the final rule. We're not going to talk about them today because proposed regulations don't have the force and effect of law, but it does give us the understanding that these are not going to be the only rules coming out, and there'll be some more final rules hopefully within the next year or so. So taking a step back for a second, the law has required beginning dates, which is a date by which participants must start to take benefits from a tax deferred retirement plan. And the idea is that money that's contributed to a pension plan is contributed on a pre-tax basis, and it grows pre-tax, and tax money doesn't start to get paid until distributions are made to participants or their beneficiaries. So rather than let money grow indefinitely until after a participant dies, the law has rules by which you have to start taking distributions from the plan. So up until the Secure Act of 2019, the rule was that the required beginning date is April 1 of the calendar year, following the later of the year in which the employee reaches 70 and a half, or retires from employment, with all employers maintaining the plan. Now, not all plans had that later of rule. That was an optional change that was allowed back in 1999, statutory changes. But some plans may just have that you have to start your benefit by April 1st of the calendar year after you turn 70 and a half. But regardless of which of those rules you have, Secure and then Secure 2.0 increase those ages. So rather than having to start benefits at 70 and a half, you can delay it to 72, 73, or 75 based on the year in which the participant was born. And I've laid that out for you on the slides. Importantly, and what was not addressed in Secure 2.0, and a lot of questions we had gotten is, can plans continue to use a mandatory distribution date based on 70 and a half? And the final rules don't address that, but the preamble to the final rules do allow plans to keep their 70 and a half age, so you're not required to change it. If you do change it, to date, there's only been very limited anti-cutback relief. So you should make sure that you work with counsel to make any changes consistent with any anti-cutback rules, so that you're not taking away a distribution option that would otherwise be available to a participant. The rules for defined contribution plans have changed significantly more than the rules for defined benefit plans. And one area where we've seen a lot of change has been when an employee dies before their required beginning date. Up until this point, the rule was that if a participant died before their required beginning date, they had to take a distribution of their entire account balance either within 5 years of the participant's death or over the life expectancy of the participant's beneficiary starting the year after the participant died. These rules have now changed with respect to defined contribution plans. The first thing that has changed is that the law now has added a new category of beneficiaries called an eligible designated beneficiary, which can either be the spouse of the participant, a child under the age of majority, spoiler alert, that's age 21 for this purpose, not 18, a disabled individual, a chronically ill individual, or somebody who's not 10 years younger than the employee. So the first thing plans are going to have to do is make sure that they differentiate in their documents between a designated beneficiary and an eligible designated beneficiary. And now there's 3 categories of rules. So the first is if you do not have a designated beneficiary, and that term designated beneficiary is defined in the code. It doesn't mean that the participant has filled out a form and designated their spouse or their child as a beneficiary. What a designated beneficiary means for this purpose is that your beneficiary is a person. So if we say no designated beneficiary, we mean that the person's beneficiary, either through designation or operation of the plan, is the participant's estate, certain kinds of trusts, or maybe a charity. So if you do not have a person designated as your beneficiary, the rules have not changed, and the entire interest in your account must be distributed by the end of the year that includes the 5th anniversary of your death. If you have a person who's a beneficiary, but they don't meet the definition of an eligible designated beneficiary, the 5 years has been extended to 10 years. And there, the distribution of the full account balance must be taken in the year that includes the 10th anniversary of the date of the participant's death. The final major change under Secure 2.0 in this area is that the life expectancy option, which I mentioned before, which is taking a distribution over the life expectancy of the beneficiary, is now only available to eligible designated beneficiaries. They can either have that 10th anniversary rule that we talked about or the life expectancy rule, but again, only an eligible designated beneficiary can elect a lifetime payment option. There are special rules if the sole designated beneficiary is the participant's spouse. Under Secure, a spouse can elect to be treated as the employee for required minimum distribution purposes. Regulations on how to implement this have generally been reserved for further rulemaking, so we don't have a lot of guidance yet on that area. Also under Secure and Secure 2.0, if an employee dies after their required beginning date, there are now two things that have to happen. One is the employee's remaining interest must be distributed at least as rapidly as the method used to pay the employee, and it must be fully paid out within 10 years of the employee's death, unless you have an eligible designated beneficiary taking distributions under the life expectancy option. And having this requirement of meeting both the 10-year rule and the least as rapidly rule, IRS notes in the preamble to the final rules that not all plans understood this, and some plans thought that they had the ability, when a participant died, to stop making annual required minimum distributions as long as they paid the entire account balance out within 10 years of the participant's death. IRS has said that's not our intent. That's not how you should be operating the plan. But because of confusion, if any plans operated in that manner from 2021 to 2024 and stopped making the required annual distributions, there will be no excise tax or tax qualification failures. There is relief for that. And one other thing of note, under Secure 2.0, before we talk about the clarifications that the final rules made to these requirements, is Secure 2.0 does specifically require that the requirement to take continual annual payments includes the year of the employee's death. So if the employee dies and a required minimum distribution wasn't made to the employee before their death, a distribution has to be made to their eligible designated beneficiary. So under the final rule, there's some clarifications to how to implement these changes. The first one is that for the eligible designated beneficiary, the plan through design can choose whether to apply that 10-year rule or the life expectancy rule, or you can design your plan to let the employee, the eligible designated beneficiary, choose. So your plan can say that it's up to the eligible designated beneficiary whether they want to take distributions over their life expectancy or a one-time payment within 10 years of the employee's death. The law also says that if you do not, if you give participants the choice, you have to designate the default option. If the eligible designated beneficiary doesn't choose which option they want, and if you don't designate a default rule, it's going to be the default rule of the Internal Revenue Code, which is the life expectancy option. So if you don't want that to be your default rule, you'll have to specify something else in your plan. Another clarification under the guidance has to do with Roth assets. And up until this point, required minimum distributions were required to be taken annually from Roth assets. But because Roth assets are post-tax, there's not the same concern about paying income tax on that money as it's distributed to participants. So recognizing this, under the final rule, if you have an account balance with only Roth assets, you are not required to make any required minimum distributions to a participant during their lifetime. If they never want to take a distribution and they pass away at 90 years old, you have not violated any laws by not sending them a distribution. If a participant is taking distributions from a Roth only account, and then they pass away before their account balance has been fully depleted, they are treated as having died before their required beginning date. So what that means is the rules we just talked about a little while ago about continuing to make distributions to an eligible designated beneficiary as least as rapidly as it was be made to the participant does not apply if you only have Roth assets, and you can make a distribution at any time within 10 years of the participant's death. If you have an eligible designated beneficiary that's using the life option payment, the final rules also say that payment must be made in the year of the eligible designated beneficiary's death. So what that means is if your eligible designated beneficiary dies and you didn't make them a distribution in that year, you have to make the distribution to their beneficiary. A fourth clarification under the rules, the final rules, is that if you have an eligible designated beneficiary that's taking the life expectancy option and they die before the account has been depleted, then there are rules by which you have to get the money out of the account. And what has to happen is you have to make a full distribution of the participant's account balance within 10 years of the eligible designated beneficiary's death, or if the eligible designated beneficiary is the participant's child under the age of 21, then within 10 years of them attaining age 21, so that they can't stretch their payments out longer than that. And then fifth, you can have different rules for different categories of eligible designated beneficiaries. So for example, your plan can say that only a surviving spouse can elect between the 10-year rule and the life expectancy rule, and all other eligible designated beneficiaries are subject to the 10-year rule. Again, that's just a plan design choice for the trustees. The final rules go into a lot of clarification as well about who is an eligible designated beneficiary. So what they say is that a child includes anybody that would be considered a child under the Internal Revenue Code. So it would include a stepchild and eligible foster children. And the age of majority for this purpose, as I mentioned before, is 21, not 18. To be considered disabled, you have to be disabled in the meaning of the Internal Revenue Code, which generally means that you can't engage in gainful employment. There is a special rule if the disabled individual is under the age of 18, since generally they're not able to engage in gainful employment, there's a separate rule to determine whether they are considered disabled to be an eligible designated beneficiary. The final rules give a safe harbor if you don't want to get into the business of determining whether somebody is or is not disabled within the meaning of these tests. Your plan can provide that the determination will be made based on a determination by the Social Security Administration, so that if you have that determination from Social Security Administration, you would automatically be considered disabled for the purposes of these rules. To be considered chronically ill under these rules, you must have a certification from a licensed healthcare practitioner that you're unable to perform at least 2 activities of daily living without substantial help. To be an eligible designated beneficiary, either because of disability or chronic illness, you are required to provide documentation to the plan no later than October 31st of the calendar year following the year of the employee's death. If the plan does not have that documentation, then the person would not be considered an eligible designated beneficiary. The final rule does give relief for this requirement for calendar years of 2020 through 2023, as long as anybody who is claiming to be disabled or chronically ill provides the supporting documentation no later than October 31st, 2025. And then lastly, there are several rules about if you have multiple beneficiaries, and with some exceptions, if you have multiple beneficiaries and at least one is not an eligible designated beneficiary, then the rules for non-eligible designated beneficiaries are going to apply. Under the final rule, there's not too many changes to how RMDs are calculated. It's more about the required beginning date, but there is one significant change that I want to touch upon, which is that prior to Secure 2.0, if you have a defined contribution plan where participants can use some but not all of their account balance to purchase an annuity contract, the prior law said that you had to satisfy the required minimum distribution requirements separately for the participants' remaining account balance and for the distributions from the annuity contract. What Secure 2.0 and the final rules allow is now to aggregate these two pieces of the participant's benefit and treat it as one for required minimum distribution purposes. So what you would do is you would aggregate the the fair market value of the participant's annuity contract with the participant's remaining account balance as of the end of the prior year. And that would be the amount that you're going to use as the base to determine how much you have to distribute each year. And now any distributions made to the participant under that annuity contract can satisfy the required minimum distribution requirements in total. So they don't have to take money out of the account balance invested with the DC plan if the distributions they're getting from the annuity contract are sufficient to satisfy the required minimum distribution rules. But remember, and this is important, when you have an annuity contract that you purchase with a defined contribution plan, the required minimum distribution rules for that annuity contract are calculated under the defined benefit rules, not the defined contribution rules. With a few limited exceptions, that is the general rule. So make sure you keep that in mind and you calculate it properly. To touch on a few other regulatory guidance that has come out in the last year related to Secure 2.0, there is some additional early distributions that participants can take from defined contribution plans that would not be subject to the 10% early distribution penalty for participants under 59 and a half. So Secure 2.0 added these two additional exceptions. One is the emergency personal expense distribution, and another one is a domestic abuse victim distribution. These two distributions, you can allow them to take before 59 and a half, again, without a 10% penalty, and there's no documentation required. You can allow a participant to self-certify, just like they can do for a hardship. If your plan allows rollover contributions, then you have to allow the participant the option to repay these distributions within 3 years of when they were made. And lastly, importantly, these distributions are not subject to the rollover rules, because if you need the money, the idea is that you don't want to let the money continue to grow tax deferred. So IRS issued notice 2024-55 to give us some additional guidance on these two distributions. And just remember, these are completely optional for your plan. You don't have to add them. And if you do not add them and a participant has a circumstance that would otherwise meet the requirements of these types of distributions, they can reconcile that on their tax returns when they file their taxes at the end of the year with the government. So all is not lost with respect to that 10% penalty. So for the emergency personal expense distribution, this is a facts and circumstances test. Really anything that is an emergency personal need, such as unreimbursed medical care, casualty to your property that's not reimbursed through your insurance, funeral expenses, auto repairs, you need a car to get to work, those kind of expenses. The distribution cannot exceed the lesser of $1,000 or the participant's vested account balance that's over $1,000. So for example, if your car stops working and you need a car to get to work and you only have $1,500 in your annuity account balance, your maximum distribution for the emergency personal expense would be $500. This amount is not indexed for inflation, so it will stay at $1,000 absent another legislative act. Under the statute, the law says that you cannot get another distribution for an emergency personal expense within 1 year of the date the distribution was made. However, under the guidance that was issued earlier this year, you have to wait 3 years to get a second emergency personal expense distribution unless the participant repays their prior distribution or the aggregate of their elective deferrals and employer contributions since the last distribution was taken was more than the amount that was taken. And again, this just highlights the tension I think that a lot of trustees feel of having the sense of this is the participants' money. We want them to be able to take it when they need it, but also encouraging them to save for retirement so that they'll have something to take out when they no longer want to work. And so here is another poll question, and this just tests what we were just talking about. Can you elect an emergency expense distribution from a 401k plan at any time as long as you have an account balance with the plan? Okay, so continuing on, this IRS notice also gives us guidance on the domestic abuse victims distribution. And this distribution is to help somebody that feels that they need to get out of an abusive situation. Doesn't have to be physical, can be sexual, emotional, economic. And it doesn't have to be of the person seeking the distribution. It can be their child or another person living in their household, but they really feel that they need this money to be able to get away from that abusive situation. This type of distribution can be added to any plan that doesn't require spousal consent for obvious reasons. So it's not available, for example, under a defined benefit plan or a money purchase plan, but could be for a profit share 401k type plan. The amount of the distributions is limited to the lesser of $10,000 or 50% of the participant's account balance. And this $10,000 is subject to cost of living adjustments, unlike for the emergency personal expense distribution. And the last thing I want to touch on today, before I turn this back over to James, is some guidance that came out on matching contributions for student loan repayments. And so under Secure 2.0, 401k, 403b, 457b plans can allow but are not required to offer matching contributions for qualified student loan repayments as if those were elective deferrals into the plan. And really the idea is that the government doesn't want people to have to decide between going to school and being able to afford their student loans and saving for retirement. There's an annual certification that you have to make sure that the actual payments have been made before the matching contributions are going to be made. And so some guidance that came out regarding these student loan repayment options give us a little bit more detail, which confirm that you have to have the legal obligation to repay the loan in order to be eligible for these elective these matching contributions on the student loan repayments. So for example, if you're a guarantor of your child's loan, you don't have the obligation to pay it unless your child defaults. Similarly, you also have to be the one to make the payments. So if you're a co-signer on the loan with your child and your child is actually the one to make the payment, you won't be eligible for the matching contribution. This is a completely optional feature for a plan. You do not have to offer it. But if you do offer it, anybody that's eligible to receive matches on elective contributions also has to be eligible to receive matches on these student loan repayments. You can't limit the types of degrees that are required for these loan repayments. And there's very specific information that you have to get in order to certify that these payments have been made before the employer can make the matching contribution. So if this is a feature that your plan is going to want to offer, we highly suggest you look at the guidance 2024-63 to make sure that you're getting the proper documentation before you make any matching contributions. So I think I've used up my allotted time and talked as quickly as I could, but I want to turn it back over to James, and I thank you all. And there's another poll question up while I do that.
All right, thank you, Meredith. I'm just going to give a few seconds for the poll question. All right. So while you're answering the poll question, I'm going to introduce our last presenter. He's Brian Eisenstein. He's the IT director at Caliber, and he's been with us since 2005. So Brian holds a bachelor's degree from University of Wisconsin at Madison, and he's got a master's degree in IT from DePaul University. So a lot of credential, Brian. He's I work closely with Brian, and he brings a lot of like new cutting edge technology solutions to Caliber, and it's helped our firm grow, and it's made the operations very optimized. He's always looking for change and looking at the latest technology products. So currently, Brian manages all aspects of our firm's security, software, and support. So Brian's going to give his insights on cybersecurity as it relates to employee benefit plans. So with that, Brian, it's all yours.
Thank you, James. All right, it's time for everybody's favorite part of one of these webinars. It's me talking about technology. So what's going on with cybersecurity today? I feel like I have to start every presentation with this, and I will until the world that we live in changes. But cybercrime, cyber attacks are still on the rise. We'll get to that in a little bit in a couple slides. Move this out of the way. And we find that across the entire spectrum that organizations are really struggling to keep pace with all these rapidly evolving threats. You think that you're doing enough, but unless you are really staying on top of it, it is hard to keep up because the bad guys in this world are quite motivated to stay a couple steps ahead of the rest of us. We're finding that as technology develops, the risks change alongside of that. One of the best examples right now is AI. There is a lot of promise as to how we're going to be able to leverage that, what it's going to be able to do for us. This wonderful idea that we might be able to regain some of our time and have the computers do a lot of our busy work for us. But that also brings risks because all of these abilities and powers are now available to people that want to take advantage of us, extract resources, and not really bring anything to the table. And then something that we talk about a lot, the weakest links, what can we do to defend? And we are seeing time and time again that it is the human element that can be the weakest link in cybersecurity defenses. We look and we see that there's different vulnerabilities with software, there's bugs, there's things that aren't set up right, but I think we'll show this in a couple of slides. It's us who are sitting at the keyboard, moving the mouse around, clicking, typing, that are often the weakest link when it comes to keeping a strong defense against criminals. So what do things look like today? This group, Cybersecurity Ventures, published a report saying that the global cost of cybercrime was projected to cross $10 trillion by next year, which is a pretty substantial, a huge number, and a decent amount of growth from 10 years ago. So that shows that we're still going upwards. We can see that according to the Verizon every year publishes a very comprehensive cybersecurity and breach report. They've got some 80-page versions full of details for nerds like me. They also have some high-level executive summaries, maybe 5 or 10 pages. That might be good if you were trying to educate yourself on what's going on in the world. But in the last one, they showed that we can see that 65% of breaches were initiated by external attackers. So that means a bad guy is trying to get in, is trying to cause a breach, compared to 35%, what's the opposite of external? Somebody on the inside. So either somebody that was trusted and acted maliciously, or somebody who made a big mistake. We can see that the next fact, next scary fact, we always start with scary facts that I have, is that 65% of the breaches involve a non-malicious element. So clicking on a link in a phishing email, configuring something on a firewall wrong, something that there's no intent to cause harm, but an action that leads to it. And then, what's this last one? 14% of breaches involved exploitation of vulnerabilities as an initial accept. So it's the numbers going up, but the thing I want to hammer home is that I spend a lot of my time personally and my team looking at vulnerability scanners, saying, what do we need to update? What do we have to close down? What do we have to change? Put a lot of effort into it, but only 14% of breaches start at that step. So it's important to take care of that, to make sure that everything is updated and secure. But that always struck me, even though it's growing, as a small number, given how much time and energy goes into responding to those vulnerabilities. All right. Some more scary numbers. We've had some large data breaches over the last, I think I got these all from the last year, maybe 2 years. National Public Data was a background check group, and they had 2.7 billion records breached. That is basically a record for like 40% of the world. They probably have lots of records on a smaller number of people, but it was giant. Change Healthcare affected a ton of healthcare providers in the United States when they got breached due to ransomware. It shut down their claims processing for some of, Change is a vendor in the healthcare space. Some of the clients that use their software can no longer process claims, provide explanation of benefits online. So not only did a lot of information get leaked there, but it also really interrupted a lot of business flows for people. Things that had previously been automated, they had to go back to manual processes involving, customer support and sending out letters in the mail versus having access online. We see that Dell and AT&T, both long-standing high-tech firms who should be in front of security, both had very large data breaches in the last year or so. One of them coming a brute force attack, where brute force basically means that an attacker is going to continually try different iterations of passwords against an account. And Dell had a portal that did not properly lock out an account after bad attempts had been entered, so that this attacker could just keep going through a database of passwords and eventually got in. AT&T, you see a similar thing, but they're in this case compromised credentials. That means somebody's username and password was leaked, and in this case, we believe it was a set of a username and password that had been used on other sites. There was a breach on another smaller site, and then these attackers take these known username and password combinations and spray them to see where they can get a successful login. So we can see that all over the place. These are all huge ones, but big and small. There's a lot of bad situations. All right. So why am I telling you all this scary stuff? I'm doing that because we need to talk about the risk that we all face with this. It's not just, hey, some data got out we have to do, but we can look at it in a bunch of different realms, right? Financial. If you suffer a cybersecurity attack, you might be not doing business for a while. You might have to stop your operations. That'll cost you. You might have to pay a settlement. You might have to notify anybody whose data was affected. That has a large cost attached to it. So there's a financial outcomes. Operational. With the case of something like ransomware, your whole network, your whole environment could be shut down for an extended period of time, and you're not going to be able to continue doing business, which goes back to the financial part. Regulatory, depending on, here we're talking about benefit plans, and the Department of Labor, which we're going to talk about in a minute, has given us a lot of advice and things that we have to follow, and eventually those are going to, be even more required. So, what do we risk by not protecting ourselves there? And then reputational, we saw these big names get hit, but I think the idea that a lot of us have is if you have one incident, that might be a learning moment. And if you have two, it says a lot about what you're doing. So this comes down to why I'm talking to you and not just a bunch of nerds like myself, is that this is not just an IT problem. This is a business problem. Cybersecurity is a business issue that requires the assistance of technology, but you need to make sure that is aligned. The management needs to be able to understand the risks and be at the table when deciding what, how, when to mitigate all of these risks. Because we're not going to be able to solve every problem. The most secure computer would be one that is not attached to the internet. But obviously, for most of the things we need to do, that's not going to work. We need to be able to communicate. We need to be able to provide access. So it's all about risk mitigation. So we kind of talked about some of the incidents that had happened. I wanted to give a high-level overview of some of the different threats and angles that are prevalent these days before we dive into the what do we do about it. So ransomware, I'm hoping everybody on here is familiar with the concept of ransomware, but it's when bad guys either get on your servers or get your data, and they will either try to charge a ransom to give you the data back. They will encrypt it so you can't have it. Other times they will say, we're going to send this to your competitors, or we're going to publish this publicly unless you pay us some amount of money. And with the prevalence of cryptocurrency, there are ways for them to get large sums of money that is fairly untraceable. So it's made it a more promising business operation for these bad actors. So yeah, that is ransomware. Denial of service, I put these in the wrong order and I apologize. Denial of service is an attack where the bad guy will just keep hammering some servers, services, email addresses that you have so that it becomes unusable. They don't necessarily have a foothold in your network when they're doing a denial of service attack, but they are requesting so much information, they are overwhelming systems, and that can also be tied to a ransom threat. Hey, we are blowing up your mail server. You're getting thousands of emails every minute, and we'll turn it off when you send us, I guess at this point, a quarter of a Bitcoin or whatever it is. Business email compromise and social engineering are kind of similar. Business email compromise is when a legitimate email account, maybe somebody that you work with, a vendor, gets overtaken, and they start sending out emails as the person who you know and trust. So you might get an email from somebody who you've worked with before. Maybe you're in the middle of something and you're kind of expecting this email, but it's not, something is a little bit off. There's a good chance that their email account has been overtaken by the bad guys. A lot of times with that, you'll see mail flow rules be set up so that any responses get automatically archived or deleted so that these bad guys can stay on top of the conversation and kind of hide in somebody's mailbox. Social engineering is just, instead of sending a virus, you might get a phone call saying, hey, it's IT, I need to get on your server or I need to get on your computer and apply some updates. We're noticing some problems on our end. Best way to get around or prevent social engineering is to make sure that you have policies and plans in place so that people can verify identification, so that both your help desk can verify when somebody's reaching out looking for some support, and your users can verify if the help desk is contacting them saying, hey, we need to help you with something. Because it can happen in both directions. So then I think the segue for all these threats is, okay, well, how do we deal with this? And a great way to start in 2021, the Department of Labor put out their cybersecurity guidelines. I'm going to go through all of those, and we'll talk high level, and then there's also been a update that they put out earlier this year. We'll talk about some of those, but I'm just going to go through each one of the 12 different bullet points in their best practices. It's been guiding a lot of what all the plans that we work with have been doing, and we've made sure that internally our cybersecurity program is kind of structured around this. But the first one is this formal documented cybersecurity program. As a nerd, this was the boring part for me. I wanted to bring in that new technology. I wanted to innovate. I wanted to, I'm going to say play. And this was sitting down and writing documents about what cybersecurity needs to look like in the firm. Kind of a best practices. Here's what we have. Here's what we want. and kind of identifying risks in all these different realms, and putting pen to paper, putting characters to a Word document as to what this looks like, so you can reference that and make the right choices as you're implementing different projects, programs, bringing in new software. It guides all of that. And this is something that needs to be done with the leadership of the plan along with IT, so that we can make sure that those different groups are aligned to help identify, you know, the risk tolerance and the mitigating effects. It's a big time investment upfront, get everything written down, but once you've done that, it pays off because it lets you verify that everything afterwards that you're doing abides by your plan. It's easy to update it over time. The Department of Labor has on their best practices a kind of starting list of policies. That is a really good kicking off point. If anybody is looking at getting into this now, I'd also recommend adding a policy specifically around the acceptable use of AI. You know, we did one of these in the summer, and I talked a lot about how AI can be used. It's important to make sure that everybody in your organization is on the same page with the risks around that. And with that, I'm going to launch my own polling question. Everyone want to take a look at that. We're just asking, does your organization have a documented cybersecurity program? Awesome. We can move on to the next slide while that's up. So bullet point number 2 on the DOL's cybersecurity best practices was a prudent annual risk assessment. A risk assessment is basically just looking at the entire cybersecurity environment and determining what risks you have, how those are mitigated, the ones that still exist, how risky are they, you know, how likely could they be taken advantage of, and what is the potential outcome of that. By doing this, you get to quantify all of the risks that you're facing and use that to decide what you're going to address and when. By doing this, it helps determine where you need to focus your resources, because there's a lot of risks out there. Some of them are going to, you know, have a really low impact. Some of them are going to have a really low probability. Those can fall to the bottom of the list. You get there when you get there, or maybe you just say, you know, we can accept this. But for the ones that have a, you know, a high likelihood or a very significant impact, those need to happen often. DOL says to do this annually. Personally, I think it needs to happen more often than that. Anytime there's any significant changes, you should be looking at the risks that you face. Anytime that there's, you know, large updates you install, or, you know, deploy new software, any big changes, that risk assessment should quickly follow, because you don't want to just say, oh, you know, we do our risk assessment in December every year. And we made some changes in March, but we'll get to it, because you know, that could leave you wide open. All right. Next bullet point that they have is a third-party audit of security controls. We think it's really important to bring in a third party, because you're going to set everything up. You're going to say, okay, you know, here's all the things we're doing, but you need to test that. So having a third party come in and poke around, see what they can do, verify that everything that you think you're doing is actually working. You know, let you know that all of the investment that you're making in cybersecurity is actually worth it. This, again, you know, should be conducted at least annually, or if you make any significant changes. It doesn't always need to be a full penetration test. If you make a change, let's say you shift from an on-premise environment to the cloud, maybe you bring in a third-party audit to just focus on that one piece afterwards. But you want to make sure that you've got, you know, a reputable, experienced firm who can come in and help you verify that all of your controls are effective. You don't want to find out that some of your controls are easily bypassed when a bad actor gets in. You want somebody who will help identify that to do that well before anyone bad discovers it. So yeah, I mean, basically this just confirms that what you've seen in the risk assessment is actually the case. You can go to the next slide. Roles and responsibilities. This kind of relates back to the well-defined, documented plan, but is important to know in the firm who is responsible for what, and that those responsibilities need to be, documented and then communicated to all of the employees. People that have roles that have more risk might need specialized cybersecurity training. This is both. I'm thinking about the IT team, but maybe any management, anybody with access to bank account information, anyone that can, initiate or transfer funds. We want to hammer home with those people exactly what the responsibilities are and support them through training as to how to get there. This is somewhere that we recommend, consider bringing outside resources if you don't have them internally. There are security companies that will kind of work as a adjacent to your internal IT team and help backstop that with their own security knowledge. That if you don't have that internally, if you don't have somebody on your team who is focused on security, it's really good to bring in somebody either through a firm or an individual who spends all their time there just to keep you up to speed and current with everything. So with that, the last point I had there, cybersecurity awareness training. Department of Labor requires that you're doing security training at least annually and keeping it updated. Like I said before, those Verizon reports reported that 65% of the breaches were related to employees. I know a lot of people might feel like I don't need to do this training again. I've done it so many times. So it's important to make sure that the content is up to date. But having a skeptical employee base in your organization is the best way to stay secure. Having people who don't initially trust any emails they get, phone calls they might receive, flash drives they find in a parking lot or in a break room. We want to make sure that our staff are that first line of defense to make sure that everything is secure. So, the DOL says that they want to see annual training. We also highly recommend doing testing. The easiest way to do this is phishing emails that you can, send out as a test. You get reports on who clicks, extra training for anybody that does. Internally, we like to brag about all of the people in our firm who don't fall for any phishing emails. In a whole year, we do a all hands meeting, and I like putting up the list of everybody who was, had a perfect response rate over the course of the year. So you need both carrots and sticks, extra training for people who fail, praise, maybe some candy for people that don't and are on top of things. All right. Let me look at my polling question for that. No. Strong access controls. So this is making sure that only people who deserve and require access to different spaces or different data have that. So a couple different ways to implement that. The first one is a strong password policy, making sure that you're not reusing passwords and they're not very weak or easily guessable passwords. We'll talk about that a little bit more because that's part of the 2024 update we got from the DOL. Multi-factor authentication. So multi-factor authentication, I'm sure that everybody's used it in some way, shape, or form at this point. But it's saying that there's 3 different factors you can have. Something that's generally a password. Something you have, that could be a computer, that could be a cell phone with an application on it or the ability to text, or something you are that's usually biometrics. Fingerprint, voice recognition, retina scanner, We don't see those as much, at least in the accounting world. But that, multi-factor is saying we want to, satisfy at least two of those questions. Before I was talking about having different policies in place to make sure that you know that you can, verify the identity if somebody needs sensitive information. So, making sure both that you have these technical controls, but that people know what rules to follow. If somebody is sending your HR department an email saying, hey, I just switched banks. I need to, change my direct deposit. What do you have in place to reach out and verify to make sure this is a legitimate request and you're not going to start sending payroll to an attacker? Part of access control is making sure that everything is on a need-to-know basis. It's called the principle of least privilege. Basically means that when you get on a computer network, some sort of system, that everyone only has access to the things that they need. That might be dividing things up by role, by department, by location, but really trying to, let's say an account gets breached, making sure that that account only had access to the narrow window that they should have needed access to. And finally, we want to be able to review these policies on the regular. It's important also to have a policy to disable access should somebody leave the fund, and review access if there's any change to a role. If somebody moves departments, if somebody gets a promotion, if somebody says this work is too hard, I want a demotion, make sure that you have a policy in place that you go and review what access they might have on your network and your systems to make sure that the access you've granted is in line with the expectations. All right. So right next to the access control procedures is also strong technical controls. There's a lot of overlap here, but this is more on the technical side, that we're going to keep everything isolated where it can be isolated. We want anything that's on our network, we want to keep it up to date. We want to make sure everything is supported by a vendor, so that if there is a new vulnerability out there, that they're going to be quickly creating an update to fix it and sending it out. We want to make sure that everything that we have all of our data is backed up. That's really important, both for data that you might have on servers locally and data that you might have in the cloud. You want to make sure that you're going to have a way, should something happen to that data, to be able to roll it back. Something that has come out kind of recently in response to the risk of ransomware is this idea of an immutable backup. That is basically a backup repository or data set that you can write to once and then never change it again. That means that the backup job is one way. So if I take a backup of my server today or tonight, then that backup will exist without being able to be changed at any point. That means that nobody can get into my backup software and change these copies of the backup I have, so you can always go back to what you had. And you'd have that for every night that you do a backup. So if you got hit by ransomware tomorrow, tonight's backup is safe and couldn't have been touched. It's a technical control, requires a little bit more overhead, but if you have an immutable backup, it gives you a great deal of ease when it comes to dealing with the threat of ransomware. All right, let's go to the next one. One of the last bullet points that I've lost track of how many bullet points we're on, but that on the DOL's work paper is encryption of any sensitive data, either stored or in transit. Encrypting data is basically scrambling it to generalize. You would need a encryption key or a password to decrypt it. And we want to do that to make sure that if anybody maybe is able to view traffic going across a network, going across the internet, that sensitive data can't be read by them. So if you encrypt something that is in transit, nobody who can see on the internet, it's bouncing back and forth, back and forth, back and forth. Nobody that might have the ability to see that traffic would be able to read it. Encrypting something in storage means if I find your laptop, I take the hard drive out and I go plug it into my computer, I can't read any of the files on your computer without your password. That's the DOL's recommendation. We also recommend implementing data loss prevention, which is a technical strategy to prevent these violations. If you're one of our clients, you might have seen this before. On the Caliber side, we are looking for social security numbers, credit card numbers, bank account information on our email. And if our mail server sees any of that information, it will reject the message outright, both inbound and outbound, saying we don't, we detected sensitive information and it is not allowed on our mail server. Please, send it through encrypted means or redact the information. But through DLP, we're able to prevent the risk of that information even existing, the sensitive data, in a non-encrypted manner. So that it's nice to have that technical backstop to the policy of, hey, don't send anything sensitive without encryption. That's that. A business resiliency program. This is huge. It breaks down in a couple different plans and programs, but basically the idea is that any sort of business disruption will have a significant impact on your cybersecurity posture. So the DOL recommends that you have a business continuity plan. That's basically how are you going to get back out up and running after some sort of disruption. A disaster recovery plan is a little bit bigger of a scale, but it's, if there's a major event at one of our sites or one of our vendors, how are we going to get back up and running? And then an incident response plan is saying, how are we going to, respond to any security incident? You want to have all three of these created, written, regularly reviewed, tested to the best of your ability. The idea here is that we are thinking through all of these hard problems and questions before there's any sort of incident or disaster, so that when or if one of these incidents happens, you can be calm, cool, and collected when responding to it. That you're just following a run book that you thought about when you weren't in a panic, and you've done all that work for yourself. Get all three of these in place. Future you will really think past you, should you ever need to open those playbooks up. The DOL also talks about responding to security incidents or breaches, kind of going off that last slide, that they want, if you have a response plan, you're going to be able to better minimize the impact of the incident. You want to have it in place beforehand, and it should cover the entire process from detection to resolution. You don't want to be making any of these decisions on the fly. You want to know exactly who you need to call, what you need to do. Make sure you've got your cybersecurity insurance in place. A lot of times a cybersecurity vendor will either want to see this before issuing you coverage, or will work with you to create these plans so they know that you are doing everything right. James, we got a couple more. I don't know if I'm running out of time, but I am also going to launch a poll so I can make sure everyone gets their CPE credit. And Nadine, we can go on to the next slide. Third, I think this might be my last bullet point on there. No, we're getting there, people. Third-party service providers. DOL here is saying, hey, we just told you all these things we want you to do for cybersecurity. It's also really important that anybody you work with who has access to your data follows these. And this makes the most sense. A lot of our clients have sent us requests to either tell you about our cybersecurity program, fill out surveys. We do this all the time. You should be doing this with all of your vendors, anybody who can access your data, because you want to say, hey, we're making all this big investment. We've got this, prudent risk assessments. We've got this well-documented plan. But if you've got a vendor who isn't following any of that, what's the point? Because they are now a big backdoor into your data. So make sure that all the service providers you use are also playing by the same rules and practices that you do. All right, we can go to the next slide. They talk about having a secure system development lifecycle. This really relates to creating software. So if you develop code in-house, make sure that you have a program in place to have a security first focus. If you have vendors that develop code for you, make sure that they've got one of these. And if neither of those are true, then don't worry about this one. I want to quickly touch on the 2024 updates. I know I'm talking a lot, so I'll try to get through it. First thing, and this was kind of surprising, that the DOL said, hey, you need to have strong, unique passwords for all employees. That should have been in the first one, saying that they have to be both strong and unique. Love people to consider different password policy tools to enhance what's built into Windows. You can have low-cost enhancements that will let you define a dictionary of words that you want to prevent. I'm happy to tell you that at Caliber, none of our passwords have the word caliber or audit or tax or accounting or CPA, because we can build a dictionary of common words that people might use that could, be targeted in a brute force attempt. We also like to encourage people to use a password management tool to create and store long random passwords. Recycling passwords between services is a big threat vector, because if one of these services gets breached, it's trivial to go and try to use that password and 1,000 other places. So if you have a unique password for every website, every service that you sign up for, the risk of them being breached doesn't really affect you because you're not reusing that password anywhere else. In the new guidance, they also talked about expanding multi-factor authentication across all internet-facing systems. Before, it was just a recommendation. Now they really want to see it. They want to see multi-factor authentication anywhere you're accessing sensitive information on your network. And then they also talk about deploying phish-resistant MFA. That is generally in the form of a USB drive or other piece of hardware that doesn't go out over the internet. It's not sending. There's no app. There's no text message requirement. Super secure, but also quite a pain to manage at scale. So we'd say consider this for more sensitive accounts. Maybe your IT team, maybe your management, or people in with access to payroll. The 2024 update includes notification for requirements that anybody whose data might have been accessed without authorization is notified without an unreasonable delay. They don't spell out in the DOL guidelines what that unreasonable delay is, but we have seen a lot of people putting it into engagement letters or addendums as to exactly when they want that notification to go out. And finally, the DOL talks about that there is an overlap between the HIPAA and high-tech rules that would also apply to health benefit plans. And they don't really issue any direct guidance, but they do call out that there is a lot of overlap and that there are differences between them, and that if you are subject to all three, you really need to be considering all three, and just saying that we apply by HIPAA, we're fine. The DOL has a couple different things that they want to see, and don't forget about them. That's all I've got.
All right, thank you, Brian. A lot of scary words like ransomware and social engineering, but it's all relevant in today's cyber world with a lot of bad actors. So with that, we are finishing up the speakers for the day, but we have a few minutes, so let's do a few Q&A questions. So I'm going to just ask the question. Any one of the speakers can jump in and answer the question. Brian, the first one seems to be on cyber. You said employees are often the weakest link in cybersecurity. What can I do to decrease the risk?
I'm back. The biggest things that we would say to decrease the risk, cybersecurity training is really important, and reinforcing that with testing and making sure that people understand it, not just that somebody watched a video, but that they can interact, that you can test them. Having multi-factor authentication across as many systems of yours as you can is a huge step in stopping a compromised password from being a big problem. But you need the training to know that if you get a multi-factor authentication prompt that you weren't expecting, to hit that big red X on your software. So it really, the training and the software go hand in hand.
All right. The next question is on the 5500. Do you think there will be many changes to the Form 5500 that will be impacted by the new administration coming in? Just jump in.
looking at Meredith, but I don't know if you have any thoughts on that, Meredith.
I don't, to be honest with you, I don't know what to expect from the new administration. I definitely don't know what to expect in terms of reporting and disclosure. You know, I do expect certain things to happen, like SFA money to possibly be diverted, or you know, some of these legislations that are proposed not to be finalized, but I'm not hearing anything with respect to any changes in tax forms or 5500s or anything like that.
And one point I wanted to make too, I know during the Obama administration, the modernization of the 5500 picked up speed and was pretty comprehensive. A lot going on there. A lot related to health and welfare plans, additional audits, which was really trimmed back during the Trump administration. And we just had our modernization of 5500 changes go into effect last year, although much more scaled down. So I don't really see probably a lot there related directly to the reporting on the 5500, most likely. It'll be a lot of other things like Meredith is mentioning, but probably not directly to the reporting.
All right. Next question is on payroll audits. How do you know if you're conducting enough payroll audits?
So you're really supposed to have a program which covers all of the employers. So they're being audited every 3 to 5 years. I think plans with very extensive listings of employers, that's going to be a little bit harder to do. So other factors that are going to come into play is looking at how much of the contributions have been subject to audit each year. And if you're getting close to like 20 or 25%, you may have hit enough. So you might want to stratify your population, looking at size of the employer, number of participants that are included, and total dollar of contributions that have been processed.
Yeah, and one thing to keep in mind also is statute of limitations, because if you're going to do a payroll audit and you want to be able to collect on the payroll audit, keep in mind what the statute of limitations is. For example, in New York, it would be a 6-year statute of limitations for breach of contract claims. So we usually make sure that the clients are auditing employers sufficiently enough within a statute of limitations, or if not, at least getting a tolling agreement so that you're not sending your auditors out there for money you can't collect.
Good point. Thanks, Meredith.
Yep. I'll do one more question. I know it's like 2:30 already. So this is on emergency personal expense distributions. Can participants just fill out a form without any supporting documentation?
Yes, it's a self-certification process. So all you have to do is certify that you meet the need for it. Just like with hardships, you don't have to provide supporting documentation for that.
All right, so let's wrap up. As we conclude today's conference, I'd like to thank everybody for their participation and all the speakers. Hope you found all the sessions good. You're going to receive an email right after this program with the materials and then instructions on how to get the CPE, the 2.5 hours of CPE. So thank you again, everybody, for joining us. Hopefully you all have a great, wonderful rest of your afternoon. Bye.
Thanks so much.
Have a great day, everyone.
Have a great day.
Bye.
Happy Thanksgiving.